All right, this video is going to be a very brief video. Just going to touch down on a few concepts today. Essentially, we're going to touch down on dividends. So without further ado, let's go ahead and get into the topic. Topic's going to be benefits of buying dividend stocks for your kids. Today, people who hold cash equivalents feel comfortable. They shouldn't. They have opted for a terrible long-term asset, one that pays virtually nothing and is certain to depreciate in value. We're at a time right now where savings accounts are, on average, I think, yielding about 0.05%. Inflation is averaging about 3.5%, 3% right now. If you leave your money in a savings account, you're going to lose out to inflation. So just by leaving your cash liquid sitting idle, you're actually losing. It only makes sense to invest at this point in time. Of course, you want to invest wisely, do your due diligence, but I mean, outside of 4 to 5 months, 6 months of living expenses, you should be putting your money to work for you. Passive income, growth, things of that nature. Now, the children are our future. Too often we neglect to take future generations into consideration. Prior generations set forth the standards and what the next generation is able to accomplish. Now, granted, I mean, you still want to work hard, but we want to make sure that we're laying the groundwork for future generations. Let's look at the benefits of setting up a trust account with dividend-paying stocks for our children. A trust account enables you to place provisions on the account, such as the beneficiary cannot touch the funds until they turn 21, or the beneficiary can only take out $200 per week, etc. Those are just examples. Trust accounts are generally going to be managed by a trustee. Beneficial owners are going to essentially have the benefit of the assets at some point. Now, I'm not here for legal advice, so if you want to get into the intricacies of trust accounts, it's going to be best that you consult with an attorney. But I just want to provide you with an introduction to some of the tools that are available. Now, I want to give an example. Southern Company, symbol SO. Let's say you had a kid in 1994 and you decided to invest $5,000 into Southern Company. Southern Company is a safe utility company that owns Georgia Power. We all know they aren't going anywhere anytime soon. A lot of us actually pay our utilities to Georgia Power. I pay my utilities to Georgia Power every month, and that's one bill that I make sure I pay on time. I can't live without my electricity. My apartment's total electric, so Georgia Power will be getting their money, and I'm sure a lot of other people think the same way. They have a very solid business model and consistent earnings. Now, Southern Company was trading at about $11.50 in 1994. So in 94, this would have purchased you 434 shares of Southern Company on that 5,000. Now, at the time, they were paying 29 cents per share in dividends quarterly. Let's look at what Southern Company paid out in dividends yearly per share since 1994. Now, I went to dividend.com. I compiled some of the historical yearly payouts on dividends since 94 on Southern Company. As you can see all the figures. It looks like the dividend has been somewhat up and down, but for the most part, it has increased. They're all the way up to paying over $2 per year currently. And as I said previously, the stock was trading at about 11 something in 1994. So had we went and invested in that share, I went ahead and crunched these numbers for you. We know that through 2002, this stock would have already paid for itself in dividends. So anything additional is money in the bank. The stock's already been paid for in dividends. Your cost basis has been covered. Any additional income is essentially free income at that point in time. You can't beat that. You can't beat a stock that paid for itself in dividends. And on top of that, you have the promise of additional potential for additional growth as well. I wouldn't say the promise, but very powerful stuff here. Very powerful. And then you also, even on a side note, I haven't even touched down on dividend reinvestment or the power of compound interest that cash could generate for you while it's sitting on the sidelines if you were to actually parlay that into other products and things of that nature. So the company paid a total of $30.42 per share in dividends through the end of 2013. This adds up to $13,202 on the original 434 shares you purchased for $5,000. So in cash payouts alone, you would have received $13,202 in cash payouts alone on that initial $5,000. That's straight cash from the company into your pockets. You can get that paid out in a dividend check. You want to set up a dividend check, but that is straight cash in your hands from that initial investment of $5,000. So now your kid is getting ready to turn 20 in 2014. They have $13,200 cash plus 434 shares of a quality stock that is trading at $45 per share. That's about $19,500 in value. I mean, the value alone, makes this a quality investment, but let alone the cash that's the good thing about dividend stocks. If the stock's not performing like you want, you do get that cash flow to kind of offset that. And you also get the potential for future cash flow. Now, I'm not giving advice. Of course, you want to do your due diligence before you jump into an investment. But I don't see Southern Company cutting their dividend anytime soon. And you have the potential to gain additional value, all for an initial investment of $5,000. That's phenomenal. This isn't factoring in what dividend reinvestment could have done for you. I did touch down on that. Imagine if our parents set us up like that. That's enough equity to start a business, get involved in real estate, etc. A nice little nest egg, and that's something that we do need to look into for future generations. I'm glad you guys took a look at my presentation. You guys have a great day. If you have any questions, don't hesitate to reach out. Thanks. Bye.